Hi, and thanks for tuning in for this quarter's Student of the Market Update. My name is Sean Bjork, and our role is to serve as the independent investment fiduciary advisor for your organization's workplace retirement savings program. We're going to dive right in. Greatest hits, quick format here for a update in what's been going on in the markets year to date here in 2024 as we approach the end of the second quarter. So let's start off on the stock side. Some of you may have noticed it's an election year, so very popular topic. And if we look at the data here, we're in the fourth best start to an election year from a market perspective in history. So that's positive news for investors and interesting to see if that continues throughout the year. Something to keep in mind as we get into sort of the silly season of election and all the coverage is that the markets tend to not care who's in office. A good example is under the prior administration, that you would have thought energy would have done wonderfully. It was the worst performing sector in the market. Under the current administration, where you would intuitively think energy would not do well, it's the best. So again, really hard to kind of try and place causality with what's going to go on in the markets to what's going on in the political spectrum. But certainly a positive start year to date. Let's see where that goes. Staying on the stock side of the coin, let's look at the big story from last year, which was the Magnificent Seven, and all these seven technology stocks that were leading the way. Now it's the Fab Five. So sorry, Tesla and Apple, but it's often easy to look at the headlines and to get swept up into thinking, hey, I could just put everything in Nvidia and I'd be in great shape, right? And if we look at the data here and we look at how individual stocks have done relative to technology-focused ETFs and mutual funds, we can see here that if there are 482 individual tech stocks listed on the NYSE and the NASDAQ exchanges, and over the last 5 years, which has been a great tailwind for US-based technology stocks, over the last 5 years, 43% of them have lost money. So it's really important to think about and remind ourselves about the benefits of diversification, right? It's easy to get swept up in the headlines and say, hey, why wasn't that me? But when things go the other way, it's really important to remind ourselves how diversification, while it never feels good, often over long periods of time can be a great strategy, even within a sector so narrow as technology. So let's start to move over to talking about bonds and fixed income. And if we look at the correlations between stocks and bonds, so really just think, how do they move together up and down? We can see that stocks and bonds have never been more correlated. So, we're breaking records in that regard. In May of 2024, it was the highest correlation that has ever been seen between stocks and bonds. So we're not getting the diversification from bonds that we historically have thought we would or historically would have gotten. The previous school of thought was, hey, just check the box in the Barclays Ag and there's your ballast and off you go. And we're not getting that lately. So the market does have a tendency to revert to the mean, and so it'll be interesting to see where this goes from this peak, and if we look historically where it has gone from prior peaks. But just something for us to keep an eye on. And so along those lines, let's go all the way over and start talking, fully about fixed income. Let's look at how fixed income has done with more, over the since the 2020 bottom of interest rates. And let's look at the funds that had more flexible mandates versus the more static mandates. And we can see here that a more flexible approach and active approaches have tended to fared better since August of 2020 when rates were at their low. So we see the categories, like multi-sector, like non-traditional bond, have fared really well or relatively well, whereas the core bond categories, many are negative. So flexibility has really paid off, and it's been really important to think about who your bond manager is and are we being active or passive in the fixed income space. And so that's not something that historically investors have had to think a lot about, right? Core bond has been core bond, and now we're really seeing those managers that have a little bit more flexibility, and those managers that are active versus just the more the passive fixed income indexes are really faring a lot better over the last 5 years. So something to keep an eye on. And with that, we're done. So, quick update in terms of the markets year to date so far in 2024. As always, thank you so much for taking the time to become a better student of the market. We're going to put some important disclosures on the screen. And while we do, just again, thank you so much for joining. Welcome your thoughts and feedback, content suggestions. Please do track us down and let us know. You can reach us. There's a button on the website to track us down. And as always, the goal for this series is to help support the important financial decisions you're making in your workplace savings plan. And to help support the decisions you're making to reach those financial goals beyond. So always happy to be a resource. Look forward to our next conversation, and thanks so much. So long.